The U.S. monetary system is a dynamic network of interconnected entities working together to create, circulate, and regulate money, while occasionally facing conflicts that impact economic stability. Key players include the Federal Reserve, U.S. Treasury, bond and stock markets, consumers, bank corporations and local banks, Congress, the Internal Revenue Service, IRS, foreign banks, and regulatory bodies like the Securities and Exchange Commission, SEC. Their interactions shape monetary policy, manage the $21,560 billion M2 money supply 2025, and influence the $150 to $200 trillion national net worth. This essay provides a clear, readable explanation of how these entities collaborate or clash, driving stability or instability in the monetary system, with a focus on their interplay and broader economic implications. Collaborative interactions in monetary policy. The Federal Reserve, established in 1913, is the central bank orchestrating monetary policy to balance growth and stability. It sets interest rates, 4.75% to 5% in 2025, regulates banks, and manages money supply through open market operations, such as buying Treasury bonds. When the Fed purchases bonds, part of the $45,560 billion federal debt, 2024, it credits bank reserves, creating new money that banks lend, expanding the money supply. This collaboration with the bond market ensures liquidity, stabilizing financial systems. The U.S. Treasury complements the Fed by printing currency via the Bureau of Engraving and Printing, as directed by Fed demand, and combating counterfeiting through the Secret Service. The Treasury issues bonds to fund deficits, like the $1,900 billion shortfall in 2024, which the bond market absorbs, with banks and the Fed as key buyers. The IRS, under the Treasury, collects taxes for $1,900 billion in 2024, reducing borrowing needs and supporting fiscal stability. Congress sets fiscal policy, authorizing spending and debt ceilings, influencing Treasury actions and Fed responses, creating a cohesive fiscal monetary framework. Banks, local, national, and international, operate under fractional reserve banking, formalized in 1791, holding 10% or less of deposits as reserves and lending the rest. A $100,000 deposit allows $90,000 in loans, creating new money. Consumers drive this cycle, borrowing $20,400 billion in household debt, 2024, for mortgages or credit cards, spending to fuel economic activity. Businesses, with $21,600 billion debt, invest in growth, further circulating money. These interactions generate transactions that bolster tax revenue and economic output. The stock market reflects confidence, with rising prices signaling stability, indirectly influenced by Fed rate cuts that encourage investment. Foreign banks, holding $8 trillion in dollar reserves, reinforce the dollar's global role, stabilizing its value in the $100 to $115 trillion global money supply. The SEC oversees markets, ensuring transparency and preventing fraud, supporting investor trust that aligns with Fed and Treasury goals. Conflicts and instability risks. Despite collaboration, conflicts arise, creating instability. The Fed's independence, designed to shield monetary policy from politics, can clash with Congress's fiscal priorities. For instance, expansive congressional spending increases deficits, forcing Treasury to issue more bonds, which the Fed may buy, risking inflation if money supply grows too fast. Critics argue this fuels currency devaluation, as seen in 2022 to 2023 inflation spikes, eroding purchasing power. The Fed's low rates and bond purchases boost stock and bond markets, inflating asset prices like the $48,200 billion real estate sector, benefiting wealthier consumers but widening inequality. Lower-income consumers, burdened by debt, face higher costs, fueling perceptions that Fed policies favor elites, a tension echoing 19th-century opposition to the first bank. Banks, profiting from interest on loans, may overlend, as in the 2008 housing crisis, destabilizing markets when defaults rise. The Fed's bailouts create moral hazard, encouraging risky behavior, a conflict with its stability mandate. The bond market can pressure the Fed if investors demand higher yields, complicating rate decisions. Foreign banks selling dollar reserves could weaken the dollar, destabilizing global trade. The Treasury's reliance on debt financing, with Congress raising debt ceilings, risks long-term sustainability, potentially undermining confidence in the dollar. The SEC's regulatory actions, while stabilizing, can conflict with market-driven banks seeking less oversight, creating friction. Stability and instability dynamics. The interplay of these entities creates a delicate balance. Collaborative efforts, like Fed Treasury coordination on currency and debt, ensure liquidity and trust, supporting a robust economy. The IRS's tax collection and Congress's fiscal oversight align spending with revenue, while banks and consumers drive growth through lending and spending. The stock and bond markets signal confidence, reinforced by SEC oversight, and foreign banks bolster global stability. However, conflicts introduce instability. Excessive money creation, from Fed bond purchases or bank lending, risks inflation, devaluing the dollar. Inequality from asset-focused policies erodes social cohesion, while political pressures on the Fed undermine independence. Over-reliance on debt, with $45.560 trillion outstanding, threatens fiscal health. Historical parallels, like the 1836 to 1913 era of chaotic state banknotes, highlight the need for centralized coordination to avoid instability, yet modern complexities demand careful navigation. Other relevant entities. Additional entities influence the system. The Commodity Futures Trading Commission, CFTC, regulates derivatives, impacting market stability. International organizations, like the International Monetary Fund, IMF, coordinate global monetary policies, affecting the dollar's role. Fintech firms and cryptocurrencies challenge traditional banking, prompting Fed adaptation, such as exploring digital currencies. These actors add layers to the monetary equation, requiring integration into policy frameworks. Conclusion. The U.S. monetary system thrives on the interplay of the Federal Reserve, Treasury, bond and stock markets, consumers, banks, Congress, IRS, foreign banks, and regulatory bodies like the SEC. Their collaboration creates money, funds government, and drives growth, stabilizing a $21.560 trillion money supply and $150 to $200 trillion economy. Yet, conflicts over inflation, inequality, debt, and independence introduce instability, echoing historical tensions. By balancing cooperation and managing conflicts, these entities sustain a dynamic system, adapting to global and technological shifts to ensure long-term economic resilience.